The difference is that you can just set and forget these kind of trades normally. You're going to have, very little downside risk. You have, if it goes down, if the Yahoo stock gets cut in half because the deal doesn't go through, you're going to lose 10 bucks. That's the maximum risk on this trade. Remember, if we had just the outright calls here, if it goes down to $10, we're going to lose $411 on those. Also, if the stock stays right in the middle, right where it is right now, we lose a maximum of $49.63, as you can see over here on the expiration graph. So our downside risk, if nothing happens, we lose 49 bucks. If you just bought the call outright and nothing happens, we're going to lose $411. What happens if the deal does go through? Well, if the deal does go through, all of a sudden the stock shoots up to 35 bucks. At $35, we're making $1,400 in profit. We have unlimited upside potential. As you can see, we can go out. I mean, let's say if somebody's crazy enough to offer Yahoo 70 bucks, we're up about $9,000 at that time. So we actually have unlimited upside potential on this. It does not stop. It continues to go up and 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 up. However, the real benefit of this kind of trade is the very limited downside risk. In fact, we can make a little bit of money if it ends up in this area right here between $15.50 and about $18 or $19. So if we trade down a little bit, we make money. If it goes up forever, we make money. If it goes down to nothing, we lose 11 bucks. Now I'm going to show you just in a second some of the other trades that I have on here, and I think you're going to find it extremely interesting when you begin to put together a portfolio of these kind of trades, how dynamic this kind of trading can really be. So here's the trade. We're buying 3 of the October 25 calls. We're selling 1 of the in-the-money July 1750 calls. And let's go back to our trade tab here just for a second. I'm going to show you how this is actually entered in my Thinkorswim platform. What I want to do is I don't want to sell a naked call. So that is my second trade. My first trade is to purchase 3 of my October 25 calls here. I just want to make sure I got the right ones. And then, so under the advanced order tab, instead of blasting all or single order, I want to do first trigger sequence. In other words, when this one gets filled, then this one gets filled. So that's what I'm going to do right now. I don't have to fool around with midpoint prices. All of the stocks that I do this on are actively traded stocks. These are all actively traded stocks. So I'm not too concerned about mid prices on these. I mean, I'm talking about 5 cents in between, the bid and the ask, which is pretty normal for almost any kind of stock that you're going to be trading on an individual basis. This is not a spread order. This is not entered as a spread order. You are entering individual option orders. The deal is that you want to get these 3 long October 25 calls entered into the market first, and then you want to sell one of the July 1750s. You don't want to do it the other way around. You don't want to sell that Yahoo call and then buy your 3 October 25 calls. You want that. You want those first. You want the July, the one that you're selling second, to be placed second. So in this platform, all I have to do is hit confirm and send. The total cost of this trade is going to cost me $411, which technically is actually the risk that you have on your long calls. Because it's not technically a spread, they don't margin it that way. They margin it based on the risk that you have in your long call. So that's just something that they do. So I'm just going to go ahead and send this in. You can see we'll probably get filled instantly. Yep, we got filled instantly because we were both at the we were exactly at the asking price on both of those. Now I have those. Now let's go over to our Analyze tab again. We'll take out the simulated trades. This green and this red line are the ones that we simulated. And you can see that we have our trade in. Our maximum risk is 44 bucks, which is at expiration of the July option. And our maximum downside risk actually improved a little bit. The most we can lose if the stock goes down to 10 bucks is $5.83. That's it. In fact, we got a little profit already. We're up $3.86. But we have not limited the upside potential of this trade. I mean, this trade can go up forever and ever and ever, and as long as we do it before October, which is kind of the target date, I figure that if anything is going to happen with Yahoo, it's going to happen by October. So if not, we can always put this trade on again. Now, if this Yahoo stock trades down a little bit, I could actually make some money right around 17.50. I'll make about 60, 70 bucks. Not a lot of money, but you know what? When you have absolutely very little downside risk, you have unlimited upside potential. You can afford to put these kind of trades on and let them go, and just kind of see what happens. So let me show you. In fact, let me go. I have it right now under my positions and simulated trades. I have a single symbol, which is just Yahoo here. What I want to do is show you some of my other trades so you can understand how I built a portfolio here of trades. Let's take a look at them and see how little risk I actually have. I have a trade just like this on the Qs that you can see. I have a position on Verizon using the same method. This is Washington Mutual Bank, the XLF ETF, and now Yahoo. So these are my trades, and this is my portfolio. Let's take a look at the expiration risk here. It's minimal. It really is minimal. I mean, if things trade down here, my total risk on all of these trades is about 94 bucks, maybe 100 bucks at the most. But I have, because of the way I've put these trades together, I have actually unlimited downside profit potential, and I have unlimited upside profit potential, and very little risk right in the middle. So I'm able to profit whether the stocks that I picked go down or go up. Let me just show you an example, because I told you that you can actually find these trades. You can actually find these trades in which you make a profit if the stock goes down. Well, in this case, Verizon had a very interesting. I set it up very, very well. And it gave me some very favorable pricing, so I had unlimited upside potential on this trade, as you can see. But also, my maximum risk is about 68 bucks. But I also make a nice profit if the stock just gets tanked and people are selling it like crazy. It doesn't matter where it goes. I'm going to make anywhere from 130 at the peak here, 158. 134, 127, 125, all the way down. Even if the stock trades down to $25 and gaps open to the downside, I'm going to make 125 bucks. All the way down to zero. I mean, if it goes down to zero, I make $125. So sometimes you can find these trades in which you, in fact, can make money whether the stock goes up or down, even though you're playing it to go up. Same thing with the Qs. I actually put this trade on in which, hey, the Qs get tanked. I still make 15 bucks. It's not a lot of money, but I still have that unlimited upside potential on these kind of trades. Who else did I have? I had Washington Mutual. Washington Mutual was a very, very favorable one. I couldn't resist this one, because if the stock doesn't move at $5.48, I make 25 bucks. I still have unlimited upside potential on Washington Mutual, and my downside risk is 22 bucks. That's it. And I've got unlimited upside potential. So if Washington Mutual all of a sudden has a great, some great report where, they're all of a sudden making money instead of losing money, and they don't have to write down a bunch of stuff, well, I've got an unlimited upside potential on this trade. And even if it trades down to like $4, I still make money. So, sometimes you can find really favorably priced trades here, and the thing is that you have to kind of keep your eyes open for. Let me take a look at my XLF trade for you, which is the final one I could show you. You have to keep your eye open. This one I traded to the downside, but I left my upside potential intact, so you can see that. Even if the XLF does in fact take off here, I can make $108, $109, $106. It doesn't matter how high it goes up. I still make money. I still make money with the trade. My maximum risk on the downside on this one is about $100, but I've got unlimited downside potential too, because if the financials really get killed again and it does go down to 10 bucks, I'm going to make $1,000 on this trade. That's the only one that I've traded puts on, because you can do the exact same thing with the puts that you did with the call.